Hello, my name is Ian Gordon. I'm the president of Longwave Analytics. Today I'd like to show you a chart which I'm sure many of you are familiar with. It's the Dow Jones Industrial Average divided by the price for 1 ounce of gold. And what I've done is something I think is unique with this chart. At least I've never seen it done this way before. What I've done is I've wrapped the Longwave seasons around the chart. For those of you who don't know what the Longwave seasons are, they're based on the Kondratiev cycle, or the Longwave cycle, which I write about and have been writing about for more than 12 years now. And these seasons are simply 1/4 of the Longwave cycle, which is approximately 60 years. So spring is the rebirth or the birth of the economy. Summer is the time when the economy reaches its fruition. Autumn is what I call the feel-good period, because it's always the time when you have the biggest speculation in stocks, bonds, and real estate. And winter is the time when the economy dies as debt is wrung out of the system. So let's have a look at this chart and see how it wraps around those seasons. Because what this means is, effectively, you only have to make 4 investment decisions in your lifetime. You either want to be invested in gold and gold stocks, or you want to be invested in the general stock market. Now, we know that spring is the rebirth of the economy, and therefore the stocks are going to perform very well at that time. So if we look from this chart, which begins in 1896 here, the ratio is 1-to-1. In other words, it takes 1 ounce of gold to buy the Dow Jones Industrials right here in July 1896. And we know now that's the end of winter. It's the end of winter. We know we're going into the spring. So at this very low ratio, you can buy stocks and sell gold. And in spring, you go up and rise because the stock market is rising in the spring. And then you go into the summer, and summer is always the inflationary period in the cycle. However, here, at this period in the cycle, the gold price has been fixed at $20.67 an ounce. So it's not going to rise just simply because inflation is rising. It's going to be stay at $20.67 an ounce. However, if we go over here, we can see, and this is another ending of spring here in our present cycle, when spring ended in 1966 and it took 28 ounces of gold to buy the Dow Jones Industrials. The gold price is still fixed. However, and at this time it's fixed at $35. However, we know now we're going at the end of spring, we're going into summer, which is always the inflationary period in the cycle. And therefore, gold is going to perform very well, and the stocks aren't going to perform very well. So we can see here we go from this very high ratio, 28 ounces of gold, to buy the value of the Dow Jones Industrial Average. And we come down here throughout the summer, the inflationary summer, where we reach, in 1980, a 1-to-1 relationship. And therefore, obviously, in the summer, we should be out of stocks and in gold and gold stocks. And of course, gold here reaches $850 an ounce, and the Dow Jones reaches about the same level. In fact, it goes down into 1982, down to 777. Then we know when we're going into autumn, we're always going into the biggest bull market in stocks, bonds, and real estate. So from this extreme low, we know that we want to sell gold and buy stocks. And we know that we're now going into this big autumn bull market, and you can see that in July 1999, it takes almost 44 ounces of gold to buy the Dow Jones Industrials. Then at that very high level, we know that we're going into the winter, and that's when we want to sell our stocks and buy gold. And because winter is a period when debt is wrung out of the system, it causes all sorts of problems in the economy. It causes major problems to both creditors and debtors, and therefore people moved to gold because they trusted it as money. And you can see since this massive high here, $44, we've come all the way down to this relationship in end of October 2011 of about 7 ounces of gold to buy the Dow Jones Industrials.